Um, well, let me do a little intro here. So, this class is all about unique loan programs and unique financing. And what I hope you get out of this is you understand all the crazy things that are possible in lending these days so that you don't walk away from a deal or a potential deal that we could help someone just because that client thought they didn't qualify or another lender told them no. So portfolio lending, we're one of the few lenders that we do both the Fannie Mae, Freddie Mac, Jumbo, FHA, and VA, but we also have our own special program that's portfolio. That means we can make our own rules. And so there are a ton of misconceptions out there about what it takes to qualify to buy a home. Like if I were to survey 100 real estate agents and ask them, how long do you have to be self-employed to qualify for a home? I bet you 90% of them would say 2 years, right? And in general, that's true on like a normal Fannie Mae, Freddie Mac, or jumbo loan. But on portfolio, we can make exceptions to those rules. Also, we have programs that don't even require tax returns. So we have clients, most self-employed people, a CPA's job is to make a person's income look as low as possible. Well, that's the opposite of my job. I usually have to make their income look high so that they can qualify for the house. So all of these programs are unique, outside the box loan programs. And what I hope you get out of it is the knowledge to know of what's possible, at least a basic understanding, so that you don't walk away from a deal, okay? Towards the end of the class, we're gonna cover condos, including non-warrantable condos, condotel, and some of the issues we're facing with condos. And we'll talk about workarounds and kind of what to look out for, okay? Feel free to ask questions in the chat or unmute your mic if you have a question, and we'll get your questions answered. So just a little bit about me. I've been doing this 20 years. My whole team's over 150 years of experience, helped 3,000 families, do professional sales and money coaching. We do over 100 million in purchase volume. I'm personally invested in real estate, but my number one goal is to help you close more homes. So not bragging on any of those points, but I've been doing it a long time so that you know, I at least know a little bit about what I'm talking about. So what I hope you take away, I want you to understand the basics of what's possible, like I said, so you avoid walking away from a potential deal. How to identify a save a deal situation when a client thinks they won't qualify or another lender says they won't qualify, and then how to use these programs to create some business-to-business referral relationships. Overall, I just want to show you some ways you can close some more deals next year. So what is non-QM? Non-QM is portfolio loans. It's basically we make the rules. Okay, so these are make sense loans. You've probably had a client before that got declined for a loan, but you knew deep down that they would make their payment. Maybe they didn't claim any income on their tax return, but they were very wealthy. Maybe they had $1 million in the bank. That client's probably okay. But the problem is with Fannie Mae, Freddie Mac, and jumbo mortgages, we have to follow the rules. Those are government loans essentially. So we have to follow the rules, and there's no exceptions to the rules. On these portfolio loans, we can make exceptions. Most of them don't require W-2s, pay stubs, tax returns, where a traditional mortgage would, okay? So lots of options to get around those incomes. What's different about us is we do all our own loans here. We're not brokering them. It's my underwriters making the decision, our own money that we're lending. So whereas a broker, if you work with a broker, they may have one lender that does bank statement loans and they have to send all the information over there, but it's not their underwriter, it's not their bank, it's not their money, they're brokering it out. And then they may have another lender that specializes in DSCR loans. and maybe another one that specializes in asset qualifier. We'll talk about what all these are in a minute. But the point is, it's not their underwriter. It's not their money. In the end, they're not making the decision. They're just trying to get the loan over to a third party that can lend on that special situation. This is one of the fastest growing sectors of loans, okay? As Fannie Mae loans get harder to do, jumbo loans get harder to do, FHA loans get harder to do, VA, these loans are actually opening up the guidelines. So you can see that the growth has been huge, and this is just in the last year, okay? So we've grown 125 million in a year. So let's go through a few of the programs, okay? So this one's called an asset qualifier program. This is for that exact scenario I just mentioned. A client has a lot of cash, but they don't claim any income, okay? So this one's really cool because we can essentially lend 80% of what the client's cash net worth is. And by cash, I mean like a cash investment. So stocks, bonds, mutual funds, crypto, retirement accounts, checking, savings, all of those would count for this program. So we add up all their assets, 80% of that asset or all their assets is what we can give them as a loan amount, okay? So if they have 5 million in assets, we can give them a $4 million loan, okay? So very easy. What type of clients this is good for? Clients who maybe just sold a business, so they have a lot of cash, but they're not claiming any income because they just sold their business. Maybe someone who's retired. They've done a great job saving. They have a good retirement account, but they're done working. All they're getting is Social Security, maybe a small pension, something like that. So they got a ton of money, but not collecting income. So that would be a good referral or a good client to fit into this box. So this is definitely for one of those situations where you're like, this person is super, super wealthy, but they can't qualify for a loan. This is ridiculous. So we can help them on these ones. Okay? Questions on this one? So no tax returns, no income verification whatsoever. We just look at the asset balances, 80% of that, that's what we can use for their loan. Now let's say they already have a loan, okay? Let's say they have 5 million in assets and they have $1 million loan. Well, we take that $1 million out, and so now we can lend them 3. So it's total mortgages, we can give you 80% of your assets. Job change would be another one. Maybe we just can't use their income, but they have a lot of money. Okay. Maybe they just became self-employed, but they have a lot of money. We can do that loan. So if their income doesn't work, but they have cash, then we can lend 80% of the cash value. Bank statement program, you've probably heard about this one. This one, what we do is we take either 12 or 24 month bank statements. We average all the deposits into the bank each month, and that's your income. We do hit them with a 50% expense. So in other words, if all your deposits totaled up to 40,000, we would use 50% of that to factor for like expenses. So we would use 20,000. However, if we can get a CPA to write a letter stating, hey, their expense ratio is blah, and it's a lower number, we'll use a lower expense ratio. So standard 50. So same scenario, you have 40,000 on average in deposits. Normally we would only count half of that, so 20,000. But if your CPA wrote a letter and said, you know, their expenses are only 25%, then we would give you 30,000 in income. Make sense? I'm throwing out a ton of terminology, so please don't hesitate to ask questions if I'm using terminology or saying anything that's not making sense. So let me give you an example of this one. I have a client we closed last month. He did auto body repair isn't even the right word. He took a normal car and like made it awesome, like souped it up super fast, made it look cool. Tax returns, he made $8,000 a month gross. Well, $8,000 after his CPA got a hold of him. On the bank statement program, he made $45,000 a month because we just added up all his deposits. So instead of qualifying for a $300,000 home, he went and bought a $1.5 million home. Okay, so that's a good example of one. I had a realtor that just bought a home, a second home in the mountains, and we did a bank statement loan. Did not qualify based on the tax returns. His CPA was extremely good, so he pretty much didn't pay any taxes. However, on a bank statement loan, we got him to about $20,000 a month in income. He was buying over $1 million second home, so we needed more than $20,000 a month. So the CPA gave us a letter stating that his expenses were 22%, and so we got to bump that income up quite a bit more, and he qualified. Okay. Now, most of these require at least 10% down. So a lot of people say, hey, you're doing all these crazy loans. Are we going back into 2008? No, they have to have good credit. They have to have down payment. And we are doing some sort of verification to verify, something. Back in 2008, it was like no income, no asset, no money down, 500 credit score, you could buy a house. So we are doing some verifications. But the bank statement program is great for people who you do have to be self-employed on this one, okay? The previous one, the asset qualifier, you did not have to be self-employed, okay? So this is great for self-employed people. Maybe you work for a lot of cash. Maybe you don't claim all your income. Maybe you get paid in cash. This is a great program for that because we can just add up all your cash deposits to qualify. So this, if you hear I write off too much to qualify, that would be one where we'd want to look at it. There's a few different ways to get this program to work for clients. So this is probably the most popular one for self-employed people who can't qualify based on their tax returns. It does have the best interest rate out of all of them. So 1099 only program. This is my realtor program, I call it. All we use is your 1099. Okay. So if you get a 1099 from your brokerage each year, we take 90% of that 1099, and that's your income. Super, super, super simple, super easy. Okay. Would also be good for any contract employee. So a lot of companies like nursing, doctors, stuff like that, they will hire you as like a consultant, and they'll give you a 1099. So you're a contract employee instead of a W-2 employee, but you're only really working for that company. So we just take that 1099, 90% of that's your income. So super, super simple, really good for realtors. Receiving a 1099 makes it really easy, okay? Profit and loss program, the CPA, no tax returns required on this one either, no pay stubs, W-2s. The CPA literally just fills out a 1099, signs it, sends it over, that's your income, okay? So this one's easy as well. It does need the CPA signature. We can also use this for ITIN. So people who don't have a social security number, they have a tax identification number. This one's really good for ITIN, people who are self-employed, because we don't need tax returns. The tax returns can get messy with ITIN. Okay. So this makes that one really easy, but really we just need a CPA signature saying how much money you made. Contractors, I-10, self-employed, multiple businesses, all work well on that one. Written verification of employment program. So this would be great for people who are paid under the table. All we get is a written verification of employment. So we reach out to the employer, they fill out a form saying how much the client made, and they send it back to us. So it's good. Also for if you're like a server or you get tips, especially cash. Those are hard to document. Under the table, this one's good for I-10 as well. Okay. So for this and I-10, we don't need pay stubs. We don't need W-2s. We don't need tax returns. Just the employer to fill out a form and tell us how much money the client is making. Investor loans or DSCR loans, these are awesome. There's no income verification whatsoever. It does have to be an investment property. So they have to be buying an investment property. The only income verification we use is the projected rent on the property they're buying. So we will send out the appraiser. The appraiser will tell us what they think the rents will be for that property. And that's the income we use. As long as the rents are 75% or more of the mortgage payment, we're good to go. So if the mortgage payment's $1,000, we just need projected rents to come in at $750 or more. So 75% of the mortgage payment is what the rents need to come in at. We send an appraiser out to analyze what the rents are. This one's really good for short-term rental properties. So if you're doing business in the mountains or anything that offers short-term rental, we can use short-term rental income. There's even a short-term rental appraisal that we can do on this one that will, short-term rental is usually going to give you higher rents, okay? So really all we need on this one is the rent projections to come in 75% or more of the payment. Let's say the rents came in a little low. We have interest-only options on this. Interest-only payments are going to be lower than your standard fixed payment. So on that interest-only payment, it's easier to get the rents to work. Okay, so if the rents came in a little low, we could always look at it interest-only for the client. Other ways to overcome a low assessment. The client, if they're able, they can put a little bit more money down or buy the interest rate down. Okay, so this one is great for investors. We can also close in the name of an LLC on this one. Okay, so super easy one to get done. Mainly for property investors, but whether it's a first-time property investor or they own multiple properties, this one's really good for those. Now, this one's hard to define. It's called bank fallout. So the Fannie Mae, just as an example, to qualify for a standard mortgage, the Fannie Mae rule book that we follow is over 1,000 pages long. And so it's not a rule book where if you check, where there's exceptions really. So if you don't check every box, you're done. So bank fallout is where we are verifying income, assets, credit, but maybe there's just one weird thing that doesn't line up with Fannie Mae guidelines or jumbo guidelines. So I'll give you a couple examples, okay, just so you can kind of understand what's possible. We had a client who unfortunately just got divorced, but she was getting a huge alimony check. Now, normally on a Fannie Mae loan, you need 3 months receipt, or sorry, six or more, sometimes 12 months receipt of any alimony or child support before we can use it. You also have to verify a 3-year continuance, meaning it's going to continue for 3 years after closing. Now, she had just gotten divorced, but had the dream home. She had one alimony check she received. We did that loan, okay? So we made an exception and did it without 6 months receipt. We only did it with 1 month receipt. I had another client. He was a surgeon from the East Coast. He was relocating out here, getting a new job with CU Medical, but that new job wasn't starting for 9 months. Now, the typical rule is your job has to start within 90 days of the closing date. And there's some other contingencies. So that's the Fannie Mae standard rule. Well, he wasn't starting for 9 months. We closed that loan, okay? So we just got a couple other verifications that said he had passed his background check, that kind of stuff, and we made an exception and closed it. Another exception, I have a client that was in the medical industry as well. This year, she went from W-2'd, so salaried employee, to a self-employed individual. So she actually went contractor with the company that she was working, or she basically essentially became self-employed, and it had only been 9 months. So we didn't have tax returns. We didn't even have 1099. She'd only been there 9 months and started in January. We got a ledger from the employer that contracted her showing how much she was making every month. And so it was from their payroll system. And even though she had recently become self-employed, only been self-employed for 9 months, didn't have pay stubs or W-2s, we had that ledger from the employer, and we used that to pre-approve her. Okay. There's probably some other I've done. You can combine some of these programs. This is also where we do our non-warrantable condo tell, that kind of stuff. But I'll get into the condo piece in a minute. But this is basically like a client doesn't qualify, and it's like just one little thing holding them up. You've ran into this before, for sure. Lender says, oh, this one little thing's holding them up. This is where we can step in and help, okay? So we do verify income on this one. We just may be using non-traditional methods to verify it. And I'll get into a few more interesting scenarios where we were able to get deals done. For national programs, so these are people who are not U.S. citizens and they don't have visas or right to work in the U.S. So these are 25% down. We either do the DSCR, so that's the rental income one, or the asset qualifier program. So I had one of these, and he was a UK citizen. And he was buying a vacation home in Greene County. And so he was a foreign national, investment property. We did the DSCR loan, so we didn't do any income verification, and it was a condo tell. So we combined like 4 or 5 different things on there to get it done. That one was a little bit of a doozy, but we got it done. So foreign national, anyone that's not legal in the U.S., no I-10, no work permit, no social, basically. So they're a citizen of a foreign country. That's where this program comes in, okay? Pay attention to this one, buy now, sell later. So listings are sitting for about 30 days. That's the median time to sell a property right now. So a lot of people find their dream home before their home is sold, but they don't qualify non-contingent. So the reason people run into issues qualifying non-contingent, there's 2 things you have to overcome. The first thing is down payment on the new home. So for a lot of people, they can't make a down payment until they sell that other house, okay? The other thing people run into is, so that's rule number 1, that's the holdup. Typically, number 1 is they don't have the money. They need the house to sell before they can make a down payment. The other holdup or challenge we run into is not only do they not have the money, or maybe sometimes they do have the money, but based on their income, they don't qualify for the mortgage payment on their current home and the new home. If your home's not sold, typically we got to count both payments against you. And for a lot of people, even W-2 people, that their income doesn't support carrying both mortgages. So it's hard to qualify them. What this program does is it allows us to exclude the mortgage payment, any mortgages, second mortgages, bridge loans on the home that they're going to sell. We don't have to count that against their income. Okay. So we basically exclude it. It's not in the debt to income ratio. And then what we can do to overcome the I don't have a down payment piece is we can either do a bridge loan or a home equity line of credit on their current home to help them get some of that money out so they can make the down payment. Okay. So we can overcome both issues with one loan by doing a second mortgage on their current home, either a HELOC or bridge loan to come up with the down payment. And then we don't have to count their current mortgage or that new second mortgage against them. So all we have to do is qualify them for the new mortgage payment. Okay. So this one we use all the time. That surgeon that relocated, we use this feature with him as well, and that exception that I mentioned, but his debt to income ratio with both houses was 65%. So he would not qualify. Most of your standard mortgages, Fannie, Freddie, VA, FHA, Jumbo, their rule is somewhere between 40% and 55% max. So he was well over that. But once we excluded that current housing payment and the HELOC we got him so he can make the down payment on the new home, he was just fine for debt to income ratio. Okay. So we use this one a lot, especially in this market where properties are taking a little bit longer to sell and you want to make a non-contingent offer to get a great deal on the new home. Gives you a lot more negotiation power if you can go non-contingent on that new home. So hopefully you all know that. So definitely jot this one down. If you have a client that says, I can't buy until I sell my home, that would be a great client for us to talk to. Any questions so far? I am just such a good explainer. Here's some of the exceptions we've done on these portfolio programs. We've done exceptions for people buying investment properties with no landlord history. We've done lower down payment. Most of these programs require 10 to 20% down, but we've done them with an exception with as little as 5% down. Credit score exceptions, loan amount exceptions, hobby farms, mixed use properties. There's just, on condos, we will talk about condos, but condos, we do so many exceptions right now. Let's see, I got a question. Does each program have a different rate? Yes, that is a great question. So interest rate's going to fluctuate quite a bit on these programs depending on a number of different things. So I would look at it this way. When you go get car insurance, they pull your driving record. They ask you how old you are. They even do male or female, what state you live in, what city you live in, what kind of car do you drive? Is it an expensive car? Is it a race car or is it a minivan? Is it a Volvo or a motorcycle? All of these things help the insurance company determine risk. And the more risky you are, so if I'm a 16-year-old male driving a Ferrari, my insurance is going to be pretty high, right? But if I'm a 40-year-old woman who's never had a ticket or an accident and I'm driving a Volvo, I'm probably going to have a pretty good insurance rate. So these mortgage rates work the same way. So if we have to do an exception, there's a little hit to the rate. If the client has a 620 credit score instead of a 740 credit score, there's a hit to the rate. If they're doing 20% down instead of 25% down, there's a little hit to the rate. So the bank statement program and the full doc program are probably the best priced programs as far as rate goes. So we typically will start there. And if they don't if we can't get them fit into there and we go into like one of the ones where there's no income requirement whatsoever, then the rate's probably going to be a little bit higher. So it's hard to say what the rate, it's hard to give you an exact rate. So it's just that we talk to them, we show them some options. What happens a lot is the rates aren't much higher, but sometimes the fee can be higher. So what we'll do is we'll try and get that fee covered by the seller. So basically, you'll see points charged on these programs. But if I can get them non-contingent instead of contingent, gives you a ton more negotiation power. Typically, we can get some of those extra costs covered by the seller. So hopefully that answers your question. If not, I'll see you tonight and you can ask more. Cool. So I mentioned briefly that you can use these programs to market to other industries. We can do marketing for you. We can get it co-branded for you with your headshot, contact info, and you can use these direct with clients. But another thing you could do is use these to target other businesses and start working that business to business referrals. So for instance, if you had a good relationship with a CPA spends all day doing tax returns and making it impossible for people to qualify for mortgages. That would be a good person to have a relationship with, because you could tell them, look, I got a way to get people approved without tax returns. You go ahead and write off as much as you can and save your people as much money as you can, because it's not going to matter. We can help them still become homeowners. So you can market these programs to CPAs. I've even thrown it out to people before that I will go meet with a CPA with you, and we could help market them together. I did this last week with a real estate agent, and we walked out with a couple referrals. So one thing on a side note, I think realtors, as realtors, you do a ton of direct to consumer marketing. So calling expired listings, calling your sphere of influence, farming, internet leads. You're calling lots of people who could potentially buy or sell a home. So you're going direct to consumer. A great opportunity for real estate agents would be to have a few other business people that work with clients who may want to buy or sell, and they refer you those clients. So you manage one relationship with a CPA, a financial planner, property manager would be a good one, a property investor, maybe they're buying multiple homes per year. These are all good people that you could market to, and we can help you with some of the marketing. And you manage that relationship, close a few deals each year from each relationship, probably easier than calling 500 expireds. So, all right, questions on the portfolio lending? Cool. In summary, don't walk away from a deal just because another lender said no or a client said, I don't qualify because of my tax returns, or for any reason, because we may be able to get it done. Okay. All right, let's talk about condos. So condos are a big, big, big challenge right now. And I'll explain why. But first, let's talk about what is a condo. A condo, to tell whether it's a condo or not, you got to look at the legal description. That is the only way to tell. Some builders built what looks like a townhome, could be 2 stories, nothing above it, nothing below it, attached to the ground. It's like a row home, but they zoned it condos. And if it's condo, we have to go through some extra steps to approve the homeowners association. If it's a townhome, we don't. Super easy on a townhome, okay? A townhome will typically have a lot number and a block number in the legal description. So it'll say lot 1 of block 2 in Aspen Grove Condo Association, okay? Or sorry, in Aspen Grove Townhomes, but basically lot and block. A condo will have a unit number. So it will say unit 1 of building 2 is usually what it looks like, you know, something like that, and Cherry Creek condos or whatever it is. Okay, so townhome, lot and block, condo, unit. Townhome, we do not have to do any additional verifications on the association. I mean, a couple, but nothing compared to condos. Condos is buying a condo. It's like having a whole other person, like approval to go through. Kimberly said, is that just for FHA or VA loans? The difference between condo and townhome? Is that what you're asking? If that's what you're asking, this is like the overall definition of a townhome versus a condo. Okay, check extra HOA. So we'll go into the differences between FHA and VA. But overall, so we'll go into that. But yeah, first you just got to understand whether it's a condo or a townhome. Now I see it messed up all the time. I will see listings that are listed as condos and they're townhomes, and I'll see townhomes that are and I'll see what looks like a townhome listed as a townhome, but it's actually a condo. Okay, so if you ever have one you want us to check out, we can do that. I also want you to learn some things to watch out for when you're looking at condos, save you some time and hassle, and then we'll go through some of the financing solutions. All right, so let's talk about FHA and VA. So if you want to scan those QR codes, I hope they work still. I forgot to check them this morning. But I get this call all the time on the weekend, and it's, hey, I need to see if this project is FHA approved or VA approved. And I don't mind taking the call, but if you scan these links and save them, you could look yourself. So FHA and VA, they have to typically be approved before your client goes and looks at them. So basically, they work apparently. So basically, the whole community gets approved if you're FHA or VA. Okay, so the whole community has to submit all their income or all their meeting minutes, and FHA reviews it. But once it's FHA or VA approved, all the condos in there are eligible. Okay. Now, if we look up the project and it's not FHA or VA approved, we can do a spot approval. Now, a spot approval means we are just looking at that one unit to get that one unit approved. Okay, so this would be one where we pull it up on the search and it's not FHA approved. So we're just going to try and get this one approved. So we can do that with FHA. We cannot do that with VA yet. Okay. Just a note on that, if it's not FHA approved, a couple things you want to understand. It's about a 50-50 chance the spot approval will work. Okay. So if your client does go under contract on that and we're going to do an FHA spot approval, I would probably wait on inspection and appraisal before we, so we don't want to charge them those things until we get it approved. Okay. Or typically we need the appraisal to get the FHA approval, but we want to look at all the HOA docs first to see if there's going to be any red flags. So we don't want to paying for inspection. We don't want to paying for appraisal until we can make sure it's approved. So just one note on that. But I would say in general, if you're listing a property not FHA approved and the buyer's agent says, hey, can we try for FHA spot approval? You just got to warn your seller it's about a 50-50 success rate. Okay. We can't start the process till they're under contract. So common issues with getting a condo project FHA approved: if more than 50% of the units aren't owner occupied, so if you have over 50% investors, that can be an issue. We want to see less than 15% delinquency on HOA dues. So that's 30 days delinquent. Has to be more than one unit. We can't have one person own more than 10%. So if there's 10 units in the project and someone owns 2, we're probably not going to get FHA approval. No litigation. There's some insurance requirements. We look at their budget and financial stability, but there's a ton more things that we have to verify, okay? That's why I say it's 50-50. These are probably the most common issues we run into. So recap on FHA. Best if it's already FHA approved. If you're doing a listing for a property that's not FHA approved and you want to get that project FHA approved, you'd have to get the HOA to buy into that. We can help you get a whole project FHA approved as long as the HOA is on board. And then if it's not FHA approved or VA approved, the spot approval 50-50 success rate, okay? Questions on FHA or VA? If you do see one that's FHA or VA approved, they're really easy to get done, easier than conventional. All right, let's talk about Fannie Freddie. So that's conventional. And I'm not specifying jumbo here, but jumbo follows these guidelines, if not more restrictive, okay? So jumbo, any loan amount over $833,000 next year, it's gonna have even more strict requirements. So there's every conventional and jumbo. If you have a buyer that's buying one or you're listing one, that buyer, every single time it's like a spot approval on FHA. So every single transaction, we have to get that unit approved. We have to get the HOA approved. So it's every single time from scratch, we have to do all the verification, okay? Now, on conventional, there's 2 types. There's a limited review and a full review. We typically want the limited review because there's less stuff to go wrong. So on a limited review, we have the HOA fill out a questionnaire with 7 questions on it. We do have to review their master insurance. So that's the whole HOA's insurance. How do you get a limited review? If it's an owner-occupied client, 10% down. If it's second home or investment, they need 25% down to get that limited review, okay? A full review is not 8 questions, it's 8 pages of questions. So because the full review, so let's say you have an owner-occupied client, they're buying, they're gonna live in the condo and they're only doing 3% down. We have to do a full review. So since it's an 8-page questionnaire instead of a 1-page questionnaire, there's just more questions that they could answer that could make our property ineligible, okay? So it's just more information, more that can go wrong. We also do a full review of the budget, and the HOA has to have a good budget. Typically, they have to be saving 10% of their revenue in reserve. If they're not saving 10% of revenue, then we need a whole reserve study to make sure they have enough money in reserve to be financially stable. We look at their CC&R's bylaws, HOA regulations, and the master insurance as well. So limited review is much easier. If you're in the mountains, we coach every client pretty much to make sure we can fit them into a limited review. Okay. So things that make a condo non-warrantable. So the term non-warrantable means it does not fit Fannie Mae, Freddie Mac, and jumbo guidelines. The guidelines are 36 pages long in the Fannie Mae rulebook. So there's a lot. And depending on whether you're limited review or full review, you could run into more of these. So these are the big ones. HOA involved in litigation, okay? Now I will let you know we overcome this one all the time. So we still can move forward if a condo project's involved in litigation, if it makes sense. And what I mean by that is there's a difference between someone who's suing the HOA for a slip and fall that we know the insurance company is going to cover anyway, as opposed to a construction defect where now we think there's something wrong with the property, okay? So we can look at litigation, and based on that, the reason for the litigation, we can a lot of times overcome that issue, okay? So litigation is not always a deal breaker, okay? So other things, short-term rentals. If the project allows short-term rentals and Fannie Mae finds out about it, Fannie Mae will not do the loan. So eventually, every property west of 470, which most of them all allow short-term rentals, are all going to be ineligible as far as Fannie Mae is concerned. Okay? We still can do Freddie Mac. This is the biggest issue we're running into on condos right now, and it's insurance. Okay? I'll spend a little extra time on this. So when I do this class live, show of hands, whose insurance went up? Everyone's, okay? My insurance tripled. I'm in like a wooded area in Morrison. And so because of fire, my homeowner's insurance tripled. But that's for everyone. Lots of wind and hail claims in Colorado. And so our insurance costs have skyrocketed. Now, if you're on an HOA board, you represent the owners in the HOA, and it's time to renew the insurance, and you're looking at the insurance options, most people are not trying to look out for mortgage guidelines when they're picking the policy they want. They're looking to save the homeowners the most money because they don't want to have to increase HOA dues. So the easiest way to reduce costs on insurance is to lower all the coverages and also increase deductibles. So you will see, and another one I just found out about is combining HOA insurance policies, even if like using different HOAs in different areas, all combining under one policy, okay? All these things make the condo non-warrantable. So you cannot have any deductible over 5% on a condo project, any deductible. So if your overall coverage is good, but you have a separate wind and hail at 10 or 15% deductible, you're now ineligible, okay? That's probably the biggest one. So if you are listing a condo and you want to save yourself some time, tell your seller to get their master insurance policy from the HOA and send it over to me, and I will tell you whether you're going to run into issues or not before you list it. Because if you are going to run into issues, there's only a certain type of buyer that can buy that property, okay? If you are going out with a buyer, this is a little harder to do, but you want to make an offer on a property. If you have time and can get that master insurance property from the listing agent, then I can look at it and tell you whether it's worth making an offer on that property. So just look out for that. Master insurance problem is the #1 killer of condos right now, okay? Couple other things just in general for Fannie Mae, Freddie Mac, conventional, if one person owns 20% or more of the units on a 21 or more unit project, or on a 5 to 20 unit project if they own 2 units or more. This one gets messed up all the time. Less than 50% owner occupied. That is a rule, but only if the buyer of the property is not going to live in it, okay? So if an investor is buying a condo in a project and it's got 75% investor already, so less than 50% owner occupancy, that won't work. But if it was someone who was going to live in the property, then the occupancy percentage does not matter. I see this one messed up all the time, where it'll be listed as a non-warrantable condo because that listing agent had it listed. The last buyer was an investor. They ran into this guideline. Investor backed out because the lender told him it was non-warrantable. So they update their listing to say non-warrantable condo only. That will kill half the buyer pool. You don't want to do that. Anytime you run into the non-warrantable verbiage or you think it's non-warrantable, I don't care if it's another lender telling you it's non-warrantable, call me and we'll straighten it out. Okay, make sure you don't list it non-warrantable, because you're going to scare away half the buyers. 10% of the budget allocated to reserves. This can be overcome as well, but it is a big red flag. Incomplete repairs is huge. Special assessments we got to look at. All of these things could be potential issues to make your project non-warrantable. And once it's non-warrantable, it doesn't mean we can't do a loan for them. It's just going to be a different type of loan. We're moving back to those portfolio loan programs I was talking about, okay? And they will have higher rates, potentially higher down payment requirements. If you're listing a condo or showing a client condos, I highly, 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 highly recommend they work with someone local like me. If they're looking in the mountains, you got to get them to work with someone local, okay? So I won't stress that too much. So if you run into a situation where you see a listing and it says non-warrantable, call me. If it's your listing, call me. I'll help you out. We'll make sure that there's not a workaround, okay? So if it's in litigation, there may be a workaround. If the occupancy is an issue, there may be a workaround. If the HOA isn't saving the 10%, there may be a workaround, okay? I had we got an insurance policy once, and they were missing a coverage. The HOA was missing a coverage that was $500 for the whole project. And without that, it was non-warrantable. We paid the $500 for the HOA to make it warrantable. So there's workarounds to issues. So just make sure if you hear that word non-warrantable and it's preventing you from moving forward, definitely call me. Like I said, if you have a listing, get the master insurance. I have an agent right now where she has a listing coming up. She's worried it's non-warrantable. We're doing a full approval before she even lists it. Make sure that she can list it correctly, okay? Buyers, this is most important. So if they're looking at a condo, I'd get them to us. If they're looking at a condo in a resort area, you have to get them to us, okay? 90% of lenders are going to run into issues, maybe even more, in resort areas, because all of those projects are falling under non-warrantable or condo-tel, because Fannie Mae does not like short-term rental anymore, and all of those properties allow for short-term rental. So pretty much everything in the mountains is starting to become non-warrantable or condo-tel, and I'll explain the difference. I have a little script there. If you struggle getting people to call your lender, you can use this in any situation. Hey, you're free to use any lender you wish. However, I highly recommend you get a second opinion from a lender who's familiar with resort areas, who's really familiar with Denver, who's really familiar with condos, jumbos, whatever it may be. Most lenders struggle with these types of things. I'm going to have Patrick's team call you. Is that okay? Cool. All right, let's talk about condo-tel. So like I said, Fannie and Freddie really pulled out of the short-term rental market. Fannie Mae says a condo-tel is a project that is primarily transient in nature if the predominant use of the units is short-term rentals or less than 30 days. So I've owned short-term rentals in the mountains for the past 7 or 8 years, and most of those communities are short-term rental. You have very few owner-occupied people living at the base of the ski mountain, okay? There are some, but most of them aren't. So Fannie Mae says those aren't eligible. They are condo-tels, okay? Now, it kind of goes Fannie Mae eligible, so warrantable condo. Non-warrantable condo is hard to get done. Condo-tel's the hardest, okay? So those are the 3 kind of levels of it. They also say even if it is the only condo-tel characteristic, the project is ineligible. So even if they just allow short-term rentals, you're done. So what that means is there's a lot of properties in the mountains that look, if you picked it up and put it in Denver, you'd be like, it's just any other condo project. But because they allow short-term rentals in it, Fannie Mae won't touch it, and they will label it condotel. Okay. Fannie Mae actually keeps a list of every project that's condotel. And they're not all on the list, but they will be. They will be. So what do they look for when we submit for condo approval? They see if the property is licensed as a hotel, motel, or resort. That used to be the only thing that would prevent us from doing a standard Fannie Mae loan on these projects. But now they look to see if it's licensed. If there's occupancy restrictions, so blackout dates, hey, you can buy here, but you can't stay here on President's Day because it's one of the busiest rental days of the year. That would be a bad thing. Rental pooling, if they offer hotel type services, so maybe there's a front check-in desk, maybe they have cleaning, maybe they have key card locks on the doors instead of traditional keys. Those are all hotel-like services. Don't have a full-size kitchen, advertise short-term rentals. So this one, they will literally Google search the project, and if there's any advertisements for short-term rentals, it's a condotel. Okay. Project is in a resort area, less than 400 square feet. Interior door, so lock-off units. Rated on a travel website, pretty much every single project in the mountains. Multiple individual units are listed or rated on a travel website. So pretty much everything west of 470 is considered condotel. What happened? Fannie Mae and Freddie Mac decided they wanted to focus primarily on owner occupancy, so making home more affordable. Remember, these are government agencies, making homes more affordable for home buyers who are going to live in it. So they actually added an extra cost to a second home purchase. So if you're looking at vacation rentals in the mountains, or actually second homes anywhere, they used to be priced out just like a home you were going to live in. You would get the same exact rate on a second home as an owner-occupied home. Fannie Mae changed that, and the fee has now gone up 1.125 to 3.875%. So that is a percentage of the loan amount. So if you had a $400,000 loan at 7%, no points because you were going to live in it, if it was a second home, you'd be charged 4 points, so 4% of the loan amount. So an extra 16 grand at that rate. Okay, so Fannie Mae said, you can still do them, but we're not big fans. So not very inspiring or good news, but we can get them done. So on any condotel or project in the mountains, the first thing we're going to try and do is get them under Freddie Mac. Freddie Mac is not as strict as Fannie Mae. So we're going to try and coach that client to do 25% down so we can get a limited review. If we get a limited review, I don't have to look at the budget. I don't have to get the bylaws. I don't have to get the meeting minutes. I don't have to do all the stuff that is required for a full review. So step one would be 25% down. That's what we're going to coach the client to do. Hopefully it's not on Fannie Mae's ineligible project list. Like I said, all of the projects west of 470 will, if they allow short-term rental, will probably be on that list eventually. If it is on the list, I may have to get a couple other documents beyond a limited review. But just because it's on Fannie Mae's ineligible list does not mean we cannot get it done. Okay, we've been able to overcome that many times. And if we can get it through Freddie Mac, that's going to be the best rate and the lowest cost for the buyer. Okay. Now, I will tell you, most lenders, if it's on Fannie Mae's ineligible list, you're done. It's now condotel. And they will say, we have no other option, sorry. We can sometimes overcome the fact that it's on Fannie Mae's ineligible list. But if we can't, we'll move on to a non-warrantable condo. And guys, this isn't just for condotel. Like if it's even a condo in Denver and someone thinks it's non-warrantable, we may be able to overcome it and still keep it in that step 1. Step 2, if now we try and get it done non-warrantable. So a non-warrantable is going to require 25% down payment no matter what. So this could be someone who wants to live in the property. Maybe if it's not a second home or investment, but they're going to need 25% down. We can get exceptions with as little as 10% down. If it goes non-warrantable, that's usually the next best rate and cost to Freddie. And if they really say, no, this is totally a condotel, we can get condotel exceptions up to 15%, but this is going to have the highest rate and cost, okay? Straight up condotels, we do them all the time, but like that, if it has a lock off, that's a condotel. If it's 100%, we're skipping step 1 and 2 and going to step 3. If it has a lock off unit, if it's licensed as a hotel or motel, properties that we can typically look at it, and in a lot of them, we've already done a loan in there, so we can tell you which bucket it's going to fit in. But we can sometimes look at one we haven't done a loan in, and just based on the amenities, the photos, that kind of stuff, we can give you a good idea of which bucket it's going to fit in. Okay. So for condos, FHA and VA, project needs to be pre-approved, or we can do a spot approval. If you're listing a condo, non-warrantable condo, condotel, or any condo, call me first and I can tell you what potential financing options are available. Limited review save the client the most money, time, and avoid surprises. Resort areas, always recommend that we talk to them because most lenders aren't going to be able to do them. My contact info is there, and if you have some more questions, feel free to ask them. I'll tell you, we just closed one yesterday. This was crazy. So the condo project, it was in the mountains. The condo project got an insurance policy with another project. So it wasn't in the same community. So they kind of combined forces. And one project was like 15 miles away from ours. So what the insurance agent did is they said, you know what, the likelihood of both of these buildings burning down together at the same time on one claim is very unlikely. So what they did was they said, hey, we're going to insure a policy for both of you, but we're going to do it for less than what it would take to rebuild both buildings because it's not going to burn down at the same time, essentially. It has to be like a major disaster. Now, that was by far one of the weirdest policies I've seen. It's becoming more popular, but it was no, 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 no. I even called some brokers to see if we could get it done, and it was no, 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 no. So what we had to do is I had to get the insurance agent to write this 4-page summary of why they structured the insurance that way, and it wasn't a risk. And we were able to get it done on our portfolio program. Okay. So there is a lot of funky stuff out there with insurance, condos, qualifying in general. So I hope what you got from this were some things to look out for to save a deal. Okay. So I'm happy to be your save a deal lender. You can call me if you have questions on a listing, a weird and interesting scenario, a client who's struggling, but condos for sure. We are good at that. And if you've had a condo listing in the last year, you probably ran into some fun, interesting situations getting the deal done. So any questions? All right, y'all will reach out to me directly if you need anything else or have any follow-ups, okay?
Hey, Patrick.
Yeah.
I'm wondering if I can get your slide deck.
Yep. And we'll send out a recording.
Okay, super. Thank you.
All right. Thank you all.